Well, everybody, welcome back to another episode of AWM Insights. We got a lot going on right now, Justin. Markets are, they're crazy right now. We hit we hit lows for the December 2020 lows across most of the indices, I believe. Last week alone, we had most of those indices off 4 to 5%. I'm getting text messages right now from clients, or I've gotten them over the past few days. Hey, are we worried? What's going on? Really, that's a big part of our role, is to go and reassure them. So I thought, it'd be fun to have a conversation with you right now and just talk a little bit about, maybe even you giving me a little bit of guidance, on how to respond to some of these questions. We've had the Fed came out, they increased interest rates in response to inflation. They're quote unquote getting inflation under control, hopefully, but that surprised us a little bit. And then we got earnings seasons coming around the corner here. So I'd love, certainly I've got my opinions. I'll throw those in, but as our CIO, I'd love to hear, how do you think I should be answering some of these questions?
There's a lot going on. Yeah, that's a kind of understatement of the year. Very much so. Markets are at lows for the year, back to the December 2020 levels. The short answer is, and we do talk about this, but it is really, really important to understand. The short answer is you probably shouldn't do much. Now, hopefully I'm giving you that answer because you have the right financial structure ahead of time, the right portfolio ahead of time. I think we'll get into that a little bit. But the second level or layer answer is, this is actually a healthy part of the markets. I think we say that in times of good markets. We also say that in times of rougher, choppier markets. And it's probably worth unpacking that a little bit more. What we really mean by that is, the reason why it's healthy is you expect to earn a rate of return because you are taking risk. What does that mean? Well, risk is the movement of price, the likelihood, or the wide range of possibilities that some asset may be priced within over, a certain amount of time, 4 years, 5 years, whatever it is, totally hypothetically. But if you are taking risk and expecting some sort of positive return, guess what? There's a range of outcomes that kind of represents that range of risk. And when you're investing in equity markets, it's no different. There is volatility and price movement that will likely happen at some point in time. The good thing is, if you structure your portfolio the correct way, you can really weather these very, very easily. It is unnerving. There's no question. We're not trying to diminish that whatsoever, but it's a great time to revisit these questions as to why, because the more you understand why, the better off you will be as a long-term investor. You have that staying power. You say, okay, well, wait, why am I doing it this way when markets are off double digits in many cases? And going back to that question, and challenging it, right? Always challenge it, and hopefully coming back to the same conclusion. Maybe you come to a different conclusion. It is something we do all the time. It gives that staying power, gives you that confidence in your approach. It's no different within sports or business, right? Everyone goes through challenging periods of time, and investing overall is no different.
Yeah, and I think that's something, I'm glad you're here saying that. It's kind of reiterating some of the points I have been telling people, and I think it is unnerving. We're not immune to that. You wouldn't be human, right? If you watched your portfolio decline and had no feeling. But it is kind of, what I've been trying to reassure clients with, and hopefully clients listening to this are getting some further reassurance, is that, there's a lot of opinion flying around there. We certainly have our own. It seems like to me that, we might be in for some more pain here coming. It's the Fed's likely going to raise interest rates again. But I thought some of the interesting stuff that we've been looking into, and even I was at an investment conference this past week with some very brilliant people on the investment side, and they laid out the data that says, even if you had the crystal ball, you knew what rates were coming. There is no actionable data or there's no action you can take based on data with any reliance on where things actually are going to go. So even though we feel like, hey, inflation is running high, Fed's likely to raise interest rates, those two data points alone don't necessarily lead you to a conclusion of, hey, we should sell out of markets and then we can get back in at when they stop raising rates. Like the correlation of all that doesn't make sense.
Totally. Now, to be fair, there's been a high correlation between those two things to date. But if you take a step back, and this is what you're alluding to, and you say, well, how much do those two things relate to one another over time in the past, in the history of the markets? And that's what you're getting at, is that there's no discernible connection. It happens, and it's happening right now. But I think I mentioned this last episode, it's going to happen until it doesn't. It's one of those things.
It's a flip of a coin, essentially.
Exactly. Yeah. It's a very, very loose connection. And I think it's also always good to have perspective. So I think that's what the purpose of this podcast is, first and foremost. But let's put some meat on that. Not only can we talk about these rules of thumb when it comes to investing, but let's just take a step back and think through what's still happening in the world. Business is still happening. There's an onslaught of negative news. There's no question that it's kind of a not only does media love periods like this, and so it sells, right? It sells clicks, it sells eyeballs, all of that good stuff. But if you take a step back, business is still happening. Positive things are still happening. Earnings season is around the corner. There's an expectation that companies are actually still going to stay in business. Right. Actually, I mean, and to be fair, I was a little tongue in cheek there, but to be fair, there's a decent expectation that earnings are still growing. Not where they were, but that they are still growing. That could change if we enter into a recession, which there's a higher likelihood we can, because of what's going on in interest rates. Again, you can't infer, make a call based on all these things. There's so many variables that are pushing and pulling against each other.
Recessions alone are right. They're back looking.
Exactly.
So recessions don't get called until they've likely pretty much ended. And then typically you see equity markets take off once they're called. Right. So I think even trying to figure out the timing of that is a futile game, right?
Totally. But going back to my point, business is still happening. Adobe just paid $20 billion to acquire Figma. I mean, that they have to have some confidence that business will return to normal, or is still somewhat normal for them specifically.
We're seeing that on the private side too, right? It hasn't slowed down the number of, companies that are raising capital that at least anecdotally, it has slowed a little bit, but we're still seeing opportunities to invest on the private side, and even opportunities in really fantastic companies, maybe in down rounds. Like, things are still happening.
Exactly. Things are still happening. Quality companies are still able to fundraise. If you're more questionable and maybe you have an idea written onto the back of a napkin, you might be having a little bit more of a struggle, and maybe the valuation that you want is not what you're going to get. I think that's another important point. Right now, what's happening in the market, so like I was alluding to, earnings are still relatively healthy. They've flattened out a little bit, but the multiple, or the price you pay for earnings, that's what's largely come down. That's where there has been a correlation with interest rates going up. The multiple you're paying for earnings has come down. Business is still happening. Even if you look at something called the ISM, which is a pulse of the economy, right? They have a manufacturing version of it and a services version of it. It is still in expansion territory. It's come down a little bit, but it still is an expansion territory. I'm not trying to be all bright-eyed and bushy-tailed around this. There is challenges. There are challenges. You
don't want to go on record and be the bull. You don't want to be the bull this year.
I think the real takeaway is that there's just so many variables that go into the economy. I do think that, like I said, there's a higher risk of recession on the horizon. When will that happen? How deep will that happen? That's where I'm not going to stake my opinion or whatnot, reputation out on the line for that one. But it is. There's a chance it could happen. A recession is not necessarily an unhealthy thing, just as markets can correct. Then that's not an unhealthy thing necessarily for equity markets as a whole. It's also important to remember, though, the economy is not the market, and those two things don't go hand in hand.
No, I think that's great to hit on. And, I think I wanted to end today, at least with this podcast for clients. And so I was thinking about what are some zingers maybe we can give clients that they're listening to this. There's a lot going on. They're listening to the news. There's, their teammates in the clubhouse are spouting off things like interest rates are going up in such a definitive way. What are a few things maybe that we could point to that hey, here's 3 bullet points that when somebody brings up kind of the current events of what's going on, what are those? And, the first one I thought was interesting, basically to close out with is just that comment. Interest rates they're going up. They're going up. We would encourage our clients listening to this say like, oh, okay, great. Which ones? Because not all interest rates are created equal, right?
They're not. They're definitely not. And we're talking a lot, or you're seeing a lot about the Fed funds rate in the marketplace. Yeah. That does impact other interest rates, but not every single interest rate will move in the exact same direction.
Right.
In fact, the Fed can increase short-term rates. The Fed fund rate is a primarily a short-term rate, or is a short-term rate. Longer-term interest rates can actually come down.
And do often
in times like this, especially if we are on the verge of a recession. Mortgage rates, right? That's an interest rate that is different. They have gone up. So that's one that's kind of gone hand in hand with the Fed funds rate. But again, they're just not all created equal. The longer term Treasury rates, they haven't gone up nearly as much as the shorter term Fed funds rate. So it's just very important to keep that in mind.
And I think the second one is inflation, certainly a topic out there right now. And so, people are worried about inflation, rightfully so to an extent. But, I think the second zinger is the best place to be in times of high inflation as a long-term investor is stocks, is equities. You should not be sitting on the sideline in cash. I mean, that's the worst place to be during times of inflation. But, this isn't a time if you have your financial structure in place, this isn't the time to try to time things based on inflation. Inflation is there. The Fed's trying to deal with it. But the best place to hide is equities.
Totally. And to your point, cash is a terrible place. You are essentially locking in a loss because cash is guaranteed not to keep up with inflation. I don't know if we're allowed to say guarantee, but you get what I'm saying. Versus equities, there might be volatility around it. There is volatility that's happening right now, largely because of inflation, or indirectly because of inflation, because of what's going on in interest rates. However, over the long period of time, if your portfolio structure is built correctly, equities have proven time and time again to not only keep up, but outpace inflation over those same exact periods of time. And then I would say too, if your portfolio is structured properly and you have shorter term needs that are very, very high priority or very important for you to meet, guess what? You can hedge inflation through something called a Treasury Inflation-Protected Security. It's a brilliant security or asset out there that literally is built to constantly keep up with inflation wherever it may be in the marketplace. And so it's a perfect hedge. Equities are the place to outpace inflation for longer term assets that you can take that type of risk with. And then there's other options to just make sure you're at least keeping up with inflation for very high priority
And the third zinger is just kind of broadly speaking, if you've built your financial structure well, you should have a lot of confidence that times like these are really indifferent to you, and quite frankly, a good sign in a way. And that's the zinger 3, is that when somebody brings up, I'm so nervous about the markets going down, et cetera, you get to have the response, if you're a client, of, hey, actually, this is great. And the reason it's great is not because it's happening because nobody likes it, but the reason why it's great is because it's supposed to happen.
Right.
This is a sign of a healthy market, and the market's digesting information that's coming out that is a surprise on some sides. Inflation was higher than we expected. That's a surprise. Interest rates going up. If earnings happen to be negative, who knows, as things kind of unfold here. But markets should go down when things like that happen. And yes, if you're trying to invest money that you need tomorrow in the equity markets, you should be really nervous. You should be unnerved. There should be issues. But if you've taken the time, like our clients listening have, to build the proper financial structure, this is just a ho-hum another day. Keep allocating to your portfolio. keep your portfolio position the way it should be based on your priorities and your overall financial structure. And this is exactly what we would expect from markets.
Exactly. And I won't add too much to it because I think that's a perfect summary. But the thing to keep in mind, S&P 500 over almost 100 years, going back to the mid 20s, has earned something like 10% plus a year.
Yeah,
that's almost 2 today. I think that number roughly is through the end of August. In order to earn that, you need times like this to happen, and I think that's just the piece to keep in mind. Granted, that's a super long period of time, but there are ups and downs over. There are a ton of ups and downs over that long period of time. And when you went in and when you're contributing and whatnot, all goes into this equation to give you this positive expected return going forward. And this period, again, unnerving, gives you confidence that should happen going forward. Yeah,
definitely. Well, hopefully this helps clients listening on, 3 kind of areas, 3 zingers maybe to use in the clubhouse. I heard this, actually, I'm just going to steal this from another podcast, but it's such a great point. The best way to learn anything is to actually teach it. So encourage clients listening, teach these three zingers, talk about them with your friends, your teammates, your family, help them to understand a better way to invest, because this is the most successful way to go about it. And if you need a quick bullet point list to help you with those zingers, it's nice to have on your phone. Shoot us a text, shoot me a text at 602-704-5574. We'd be happy to shoot you out a quick summary here. I mean, 1 sentence and then the 3 bullet points that you can have handy in a conversation. But we'll close out. Until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.